Hello, and welcome to Arnerich Massena's third quarter MarketCast. The world economy is now going through a major transition, with central banks moving away from their easy money policies that they've had in place for more than a decade. This has been driving a massive reset in financial markets and has led to some historic declines in stocks, bonds, and mixes of the two. While this economic transition has been difficult for us as investors, I believe that it will turn out to be a much-needed reset that will build a foundation for better long-term returns in the future. Here, we can see the magnitude of declines that stocks and bonds have been going through. In fact, this has been the worst 3 quarters for the S&P 500 since 2002, and it is also the worst for the Barclays Aggregate Bond Index since it was created in 1976. However, hedge strategies outperformed long-only stocks and bonds, and short-term investments such as treasury bills preserved capital and actually earned a positive return. So let's take a look at how the year-to-date numbers would apply to a traditional 60-40 portfolio. What's been particularly unusual about this year is that prices of both stocks and bonds have been falling together, with neither asset class protecting investors from the overall market downturn. As a result, for the year through September, a classic 60-40 blend of stocks and bonds was down 19%, putting this year on track to be the worst since 1937. This poor performance of a traditional 60-40 mix also highlights the importance of seeking diversifying alternative investments that can perform when traditional markets are falling. For many investors, stocks make up the biggest part of their portfolio, so it's only natural to ask, when will stocks recover? Well, the good news is that following a market downturn, stocks often do recover quickly. Since 1926, the median time for an S&P 500 to fully recover from a 5 to 20% decline has ranged from about 4 to 32 months. That's a median recovery of about 3 years. However, sometimes recovery can take a lot longer. The slowest recovery for the S&P 500 happened back in 1929 when the market crashed, and it took 15 years for stocks to get back to a new all-time high. And now, let's explore the current market. And for this, I'll turn it over to Senior Research Analyst Ben Larsen.
Thank you, Bryan. Let's start by looking at inflation, which has been the main catalyst for this year's downturn. Here, we can see that in July and August, inflation declined, mostly on falling energy prices. However, prices for food, shelter, and services have continued to trend higher. And we notice that shelter is the largest component of the CPI basket at 32%. Now, it's important to understand that the CPI shelter cost is calculated using 2 components: rent, and for owner-occupied homes, rent paid for comparable rental homes. And since rent payments don't change during a typical 12-month leasing period, that means that the shelter component of the CPI will tend to be sticky and move with a lag relative to new listings. So, despite the recent decline in energy prices, we think it's possible that high CPI numbers will keep coming out for a while. In order to drive inflation back down to the Federal Reserve's 2% target, the Fed has been raising interest rates at the fastest pace in decades. In just 7 months, they've hiked the short-term Fed funds rate by a full 3%. And they've sent a very clear and powerful signal that they intend to continue raising rates until the job is done. So, what does this surge in interest rates mean for investors? Well, here we can see how bond yields have been rising rapidly in response to and in anticipation of additional federal rate hikes. At the end of the third quarter, the yield on the 1-year U.S. Treasury bill was 4.1%, and that's more than 10 times higher than what it was at the beginning of the year. Now, these higher yields mean lower prices for existing bonds, but also the opportunity to earn higher future income from newly purchased bonds. And this massive increase in bond yields has not only encouraged savings and discouraged borrowing, but it's also caused a major repricing of most investments. But despite the huge disruption that rising interest rates have caused, there's one long-standing market trend that has still not reversed. And that's the leadership battle between US and international equities. Here, we see that over the past 5 decades, equity leadership has frequently alternated between US and international stocks. However, since 2007, US stocks have had an extended run of outperformance. This long-running dominance of US stocks has been helped by the US dollar's exchange rate, which has risen 17% this year to its highest level in 2 decades. So now, US stocks are looking fairly expensive relative to non-US stocks. And the pricey US dollar has become a growing problem for US companies that sell products overseas. But despite the fact that a major rotation back to international leadership seems long overdue, we also recognize that international companies and economies are facing a number of fundamental challenges that may delay this rotation. So, as we think about the leadership battle between US and international stocks, we might also want to think about the benefits of periodically rebalancing our portfolios. Rebalancing a portfolio back to its target weights is not just about trying to boost returns by buying low and selling high, but it's also about managing risk, as this chart shows. Here, we compare a simulation of thousands of rebalanced portfolios and non-rebalanced portfolios. And we find that over a 10-year holding period, periodically rebalanced portfolios usually exhibit lower volatility than ones that don't rebalance. And this happens because rebalancing involves trimming the fastest growing assets. And these are the ones that tend to be the most volatile. So as we go through this period of market turbulence, we're seeing a big increase in the number of rebalancing opportunities that come our way. And now, for more about rebalancing and our portfolio strategy, I'll hand it back over to Bryan.
Thank you, Ben. We're currently holding steady in our tactical views, and we're continuing to take a neutral view in most areas. For conservative investments, we prefer cash and low duration for its superior yield and reduced interest rate risk. And on the growth side of the portfolio, we're emphasizing hedge and diversifying investments for their risk reduction and diversification potential. In terms of our outlook for the markets, given the Fed's plans to push interest rates up into the pain zone, we're expecting continued market volatility, potentially with some major dislocations and inflection points. And given how interest rates have already climbed, I think we could be seeing some new opportunities as soon as the next few quarters. And if those opportunities do arise, it'll be important that we're ready to act quickly. So it's clear we need to be nimble and prepared. This is why we're looking to keep leverage low, keep liquidity high, and periodically rebalance the portfolio to manage risk and potentially add return. And we're also leaning into active managers who can quickly respond to market changes. But as always, please bear in mind that markets are dynamic and that our views may change as new events unfold. Your advisor will work closely with you on specific opportunities as they become available. Please join us on October 25th at 11 a.m. for a special live webinar presentation on intentional investing, featuring a special guest panelist, Sherwood Yoon, from the Vanguard Personal Index Fund, who will discuss how investors can engage in a tax-advantaged strategy and align their portfolios with their personal values. Visit our website or ask your advisor for more information on getting registered. We look forward to seeing you there. Thank you for joining us today.